Well, I'm John Kreidler. Welcome to This Week in the Markets. On Wednesday, the Federal Reserve delivered what might be called a hawkish cut. It lowered the federal funds rate by a quarter of 1%, 25 basis points, to a range of 4.25 to 4.5%. It also issued the summary of economic projections. It increased its forecast for GDP, but also increases forecast for inflation going through to 2026. It looks at inflation not getting down to 2%, its mandate now until 2026. In the press conference, Chair Powell actually talked about the idea of inflation being stickier than he thought. Likewise, he also said that the job growth slowing down, it's an equal balance between being concerned about inflation and making sure the labor economy stays strong. The bond market took this, that there will be no more rate cuts, much more than one or two, down to 3.75 or 4% of the Fed funds by the end of next year. The bond market sold off, interest rates rose across the entire yield curve from the 2-year to the 10-year, with the 30-year Treasury actually over 4.5%, which is where the Fed funds rate is right now. The stock market indexes also discounted any rate cuts. It sold off quite a bit from 2 or 3%, depending on the index itself. All this remains to be seen what happened in January as the inauguration of President-elect Trump takes place and he issues his policy edicts in terms of what type of budget and what type of fiscal policy he would like to have. There might be a confrontation between the monetary side of the Federal Reserve and the Trump administration's fiscal policy. That all remains to be seen. I'd like to take this opportunity to wish everyone a Merry Christmas, a Happy Hanukkah, and a happy and healthy New Year. Thank you so much. This was John Kreidler, This Week in the Markets. Thank you.